damage. This is certainly an example of the cure being far worse than the disease. You know, the monetary and fiscal policy is what's going to make the economy much sicker than COVID-19. I mean, first of all, we have highly incentivized people not to return to work. The majority of people receiving extended and enhanced unemployment benefits are being paid more not to work than what they were earning when they still had jobs. Well, most people don't want to work. They only work to get the money. Well, if you can get more money and not work, hey, that's a great deal. In fact, even if they extend the benefits but diminish it so that you get paid the same amount not to work as you were earning when you were working, that's still a powerful incentive because most people don't enjoy their work, especially if you're a lower income. You're tolerating your work because you want the check. If you could stay at home and just stay in your pajamas and watch Netflix and make the same amount of money as if you had to go back and forth to work every day, get up early in the morning, get dressed, commute into work, and do a job that you hate, and then come back in the evening, you could stay at home all day and hang out with your kids or your wife, if that's what you want to do, or your friends. Most people would choose that than being part of the rat race. So people are not going to return to work. We have tremendous numbers of people now that are just permanent wars in the state. But also, well, I mentioned that the financial crisis was kicked off because people defaulted on their mortgages. Well, now people are defaulting on a lot more than their mortgages. They're defaulting on everything. They can't pay their student loans. They can't pay their car loans. They can't pay their credit card debt. And it's not just Americans that can't pay their bills. Landlords can't pay their mortgage because they're not getting any rent. And even commercial landlords aren't getting rent. In fact, the whole real estate industry is imploding. Stores are shut down. Restaurants are closed permanently. They're not paying their rent. You know, clothing stores, movie theaters, gyms, all these companies are out of business. They're not paying their rent. The commercial real estate market is imploding, right? At the same time, the residential real estate market's imploding. This is a disaster. Look at the banks. The U.S. banks continue to weaken. They're the weakest segment of the market. The only part of the U.S. market that's going up is a handful of overpriced tech stocks that are being bid up based on cheap money and momentum, and a lot of shorts being squeezed out of their positions. But if you look at stocks that are actually trading on fundamentals, like the banks, they're a disaster because people buying them realize that their earnings are going to implode because they can't collect on their loans. The people they loan money to can't repay them. And the collateral behind those loans is collapsing. They can't make new loans because they can't make any money because rates are at zero. So the banks are toast. All these big banks that we bailed out after the last financial crisis are in much worse shape. People are downplaying this. They think the banks are in better shape. They're not. The banks are in worse shape. We're even more vulnerable now than we were back then. Except what's ultimately going to crush the banks is going to be when the Fed loses control of interest rates and inflation sends interest rates higher, because that's what's going to happen because of all the money that we're printing. Now, the QE1, 2, and 3, that was also inflation. And that inflation was predominantly, held or stayed in financial assets. So the Fed inflated real estate prices, stock prices, bond prices. Consumer prices went up, but 2-3% a year, whatever it was, maybe more than that, because the Fed's method of measuring them isn't that accurate. But we didn't have a tremendous amount of increases in consumer prices, but we did have a big increase in financial asset prices. Well, this time it's going to be the opposite. It's going to be consumer good prices that are really going to go up. And the reason is going to be the dollar. The dollar is going to tank. Last time the dollar went up. And the reason the dollar went up is because the Fed convinced everybody that QE was temporary, that it was an emergency measure, that it would never be implemented again, that the Fed was going to shrink its balance sheet back down to where it was pre-financial crisis, that it was going to normalize interest rates, and everything was going to be fine. And the markets were dumb enough to believe the Fed. Now, I was warning for years that the Fed was lying, that what they were claiming they were going to do was actually impossible, that you cannot lever the economy up and then take away the cheap money and expect the economy that was propped up based on cheap money not to implode. I said it was like, getting somebody high on drugs and then denying them the drug and expecting them to stay high. It doesn't work that way. Without the drugs, you have withdrawal. And, the withdrawal started to come in at the end of 2018. But what's going to happen now is nobody is going to be dumb enough to believe, even if the Fed is arrogant enough to pretend that the Fed could ever normalize interest rates, or that the Fed could ever shrink the balance sheet, which is now over 7 trillion. The national debt is 26.5 trillion, headed to 50 trillion. The balance sheet is headed up to 10, 20 trillion. And if the Fed couldn't shrink a $4.5 trillion balance sheet, how's it going to shrink a $10 trillion balance sheet? I mean, it's not even going to try. I mean, it's worse than impossible. And if the Fed couldn't normalize interest rates when the national debt was 16 trillion, how's it going to do it when it's 30 trillion or 50 trillion? See, the more debt we have, the harder it is to raise rates, and the more dependent we are on rates being at zero. In fact, pretty soon zero will be too high. The markets we have so much debt that we can't even afford zero. We're going to have to make rates negative. So this whole thing is going to collapse probably before we even get to negative. The bottom's going to drop out of the dollar because we no longer have the expectation of normalization of rates, of a shrinking in the balance sheet. People are going to realize that the Fed is locked in this monetary roach motel. They should have realized it when I first pointed it out, but they'll realize it now. And then everybody's going to want out of the dollar because we have massive trade deficit, massive budget deficits. We have $3-4 trillion a year deficits, which will probably go up to $5 trillion a year plus in a Biden administration. There is no way the world is going to finance this. They're not going to divert all those resources so that Americans can have all this government for free. The rest of the world has their own problem. The coronavirus or COVID-19 isn't just in America. A lot of other countries are dealing with it. They can't deal with their problems and our problems at the same time. So they're going to let the dollar go, and the dollar is going to collapse. And ultimately, that's going to send up consumer prices, inflation, interest rates here in the United States. And we are in for a rude awakening.